the number that stopped me cold. My name is Kevin Price, and I want to start this video with a number. $1,728. That is the price some of the most serious and most quietly watched analysts in the hard asset world are beginning to attach to silver. Not as a fantasy, not as a clickbait headline, but as a mathematically derived target based on historical ratios, current supply dynamics, and the behavior of money in a world that is rapidly losing confidence in paper currency. Now I know what you are thinking. That number sounds extreme. It sounds like the kind of figure that belongs on the cover of a sensationalist newsletter, not in a serious financial conversation. And I understand that reaction completely, because when I first encountered that target, I had the exact same response. I pushed back against it. I stress-tested it. I looked for the holes in the argument. And what I found, after doing that work honestly, is what I am going to share with you today. But before we get into the mechanics of how that number is derived and what it would mean for the broader financial landscape, I want to tell you about a moment in my own journey that made me take numbers like this seriously rather than dismissing them out of hand. There was a period early in my investing life when I had a very rigid sense of what was possible and what was not. I had anchored my expectations to recent history, to the price ranges I had watched assets trade in for the years I had been paying attention. And that anchoring, that unconscious assumption that the recent past was a reliable guide to the future, caused me to miss opportunities that in hindsight were sitting directly in front of me. I remember a specific conversation with someone who had been studying hard assets far longer than I had at that point. He told me something that I initially dismissed, but that has stayed with me ever since. He said that the most powerful moves in any market happen when the majority of investors consider the target price to be impossible. Because impossibility keeps the crowd out, and when the crowd is out, the asset accumulates quietly in the hands of the few who did the work. And then when the move finally happens, it happens fast, it happens hard, and it leaves the skeptics watching from the sideline trying to understand what just occurred. That conversation planted a seed, and over the years, as I watched asset after asset reach prices that the consensus had labeled impossible, that seed grew into one of the most important principles in my entire financial framework. Never confuse improbable with impossible. And never let your emotional attachment to current prices blind you to what the underlying fundamentals are actually saying about future value. So, let us talk about silver. And let us talk about why the gold and Bitcoin communities, two groups that have historically operated in somewhat separate orbits, are both paying close attention to what is happening in the silver market right now. The title of this video connects three assets deliberately: silver, gold, and Bitcoin. And that connection is not accidental. These three assets share a fundamental characteristic that sets them apart from most conventional investments. They are all, in different ways, expressions of distrust in the traditional financial system. They are all stores of value that exist outside the direct control of any single government or central bank. And they are all currently experiencing a moment where the forces driving demand are strengthening simultaneously, while the forces constraining supply are becoming more acute. When serious investors in the gold space and serious investors in the Bitcoin space are both turning their attention towards silver, that convergence of interest from two communities that understand scarcity and monetary value deeply is itself a signal worth examining carefully. Gold investors understand monetary history. They understand what happens to hard assets when governments debase their currencies. They have studied the cycles. They have seen how gold behaves when the financial system comes under stress. And many of them are looking at silver right now and seeing something that gold offered years ago. An asset that is fundamentally undervalued relative to its monetary and industrial importance, sitting at a price that has not yet reflected the full weight of the forces building behind it. Bitcoin investors understand scarcity in a different but equally powerful way. They understand what it means for an asset to have a fixed or constrained supply in a world of infinite money printing. They understand the mathematics of scarcity and value, and many of them are looking at silver and recognizing similar dynamics. A genuinely scarce physical asset with growing demand and a supply side that cannot respond quickly enough to bridge the gap. When these two communities, both sophisticated in their understanding of value and scarcity, both arrive independently at the same conclusion about silver, the serious investor's job is not to dismiss that convergence. It is to understand it, to examine the reasoning, and to decide, based on that examination, whether the thesis deserves a place in their own financial thinking. That is exactly what this video is designed to help you do. Not to tell you that silver will reach $1,728, not to promise you returns or predict timelines with false precision, but to walk you through the reasoning clearly enough that you can evaluate it yourself with genuine understanding rather than either blind acceptance or reflexive dismissal. In the parts that follow, we are going to look at where the 1728 figure actually comes from and what assumptions it rests on. We are going to examine the relationship between silver, gold, and Bitcoin as complementary stores of value, and what the current positioning of smart money in all three tells us. We are going to go deep on the supply and demand fundamentals of silver, and why the current price represents what many serious analysts consider a historic mispricing. We are going to talk about the practical and psychological challenges of holding a position like silver through the volatility that precedes a major move. And we are going to close with a clear, honest framework for how to think about silver's place in a serious, long-term portfolio. This is going to be a thorough conversation, one built on respect for your intelligence and your time. Stay with me, because what comes next is where the real substance begins. Where does $17,028 actually come from? Let me give you the honest answer to the question the title raises. The 1728 figure is not random. It is not invented for shock value. It is derived from one of the oldest and most studied relationships in monetary history, the gold to silver ratio. Throughout most of recorded financial history, the ratio of gold's price to silver's price has averaged somewhere between 15-to-1 and 20-to-1. That range was not arbitrary. It reflected the natural geological abundance of silver relative to gold in the Earth's crust. For every 1 ounce of gold that exists naturally, there are approximately 15 to 17 ounces of silver, and for centuries, the market priced them accordingly. Today, that ratio sits at roughly 80-to-1, sometimes higher. What that means in plain language is that silver is historically cheap relative to gold by a significant margin. If gold is currently trading around $3,000 an ounce, and the ratio were to return to even its more conservative historical average of around 17-to-1, the implied silver price lands in the range of $1,700 or above. That is where the number comes from. It is not a prediction. It is a mathematical consequence of ratio normalization. Now, the critical question is whether that normalization is realistic. And here is what makes the current moment different from other periods when the ratio was elevated. In the past, a wide gold-to-silver ratio existed in environments where silver's industrial demand was modest. Today, silver is being consumed by the solar industry, the electric vehicle industry, the semiconductor industry, and defense technology at rates that were unimaginable even a decade ago. The industrial floor under silver's price is higher and stronger than it has ever been in history. This means the ratio has two forces pushing it toward normalization simultaneously. The monetary argument, which mirrors what drove silver's historical relationship with gold, and the industrial argument, which is entirely new and entirely structural. Both forces point in the same direction. Bitcoin investors understand this kind of thesis intuitively. They have watched an asset go from being considered worthless to being considered a legitimate store of value as the underlying scarcity argument became impossible to ignore. Silver's scarcity argument is physical and geological rather than mathematical, but the logic is structurally similar. And that similarity is precisely why the overlap between the gold community and the Bitcoin community in their attention toward silver is not a coincidence. Silver to $1,728? Gold and Bitcoin investors watching. Part 3 of 5. The supply-side story nobody is telling loudly enough. If the ratio argument is the mathematical case for silver, the supply story is the physical one. And in many ways, it is even more compelling. Because you can debate ratios and historical averages. You cannot debate geology. Silver mines are not factories. You cannot simply decide to produce more silver and have it arrive in the market 6 months later. The process from discovery to production is measured in years, sometimes decades, and the current pipeline of new silver supply is not equipped to meet the demand that is already here, let alone the demand that is coming. Here is the reality of where silver supply stands right now. The majority of silver produced globally does not come from primary silver mines. It comes as a byproduct of mining other metals, copper, zinc, lead, which means silver production is not independently controlled by silver demand or silver prices. It is a passenger in someone else's vehicle. When those base metal mines slow down or face their own supply constraints, silver supply tightens automatically, regardless of what silver's price is doing. Primary silver mines, the ones that exist specifically to produce silver, are facing declining ore grades. The easy deposits have largely been found and exploited. What remains requires more energy, more capital, and more time to extract. The cost of production is rising, and the number of significant new silver discoveries has been falling for years. Now place that constrained, structurally limited supply picture against a demand landscape that is accelerating in multiple directions at once. Every solar panel requires silver. Global solar installation targets for the next decade imply silver consumption figures that current production cannot satisfy. Every electric vehicle contains silver in its electrical systems. Every advanced semiconductor uses silver. Every modern medical device, every 5G antenna, every piece of defense electronics. Silver is not optional in any of these applications. There is no substitute that performs at the same level at scale. The result is a market where the deficit between what is being produced and what is being consumed is not a temporary imbalance. It is a structural condition that is getting worse, not better, with every passing year. And above-ground stockpiles that were once large enough to buffer that deficit are being drawn down consistently and are not being replenished. This is the physical reality underneath the price. And physical realities in commodity markets have a way of asserting themselves eventually, regardless of what paper markets, futures contracts, or conventional wisdom says about price. When the physical supply genuinely cannot meet physical demand, the price moves to find a new equilibrium. And given the scale of the imbalance building in silver right now, the distance between the current price and that new equilibrium may be larger than most investors are prepared to consider seriously. The gold community understands supply constraints deeply. They have watched gold's mining supply grow at less than 2% annually for decades and understood what that means for long-term value. The Bitcoin community understands hard supply limits at a mathematical level that is almost philosophical. Silver's supply story combines both of those frameworks. A physically constrained geological resource with accelerating industrial consumption. That combination, understood clearly, is what is drawing serious attention from both communities simultaneously. The psychology of holding through the storm. Understanding the thesis is one thing. Holding through the journey to its destination is something else entirely. And this is the part that most financial content skips completely because it is uncomfortable. It requires talking about human weakness rather than market strength. But it is arguably the most important part of this entire conversation. Let me be direct with you. Even if everything we have discussed is correct, even if the supply deficit is real, even if the ratio normalization is inevitable, even if the industrial demand trajectory is exactly what the data suggests, the path between here and 1728 is not going to be a straight line. It is going to be volatile, frustrating, and at multiple points genuinely frightening for anyone who is not psychologically prepared for what that journey looks like from the inside. Silver is one of the most volatile commodities in the world. It can rise 20% in a month and then give back half of that gain in a week. It can sit completely flat for months while everything around it is moving, and make you feel like you made a mistake. It can drop sharply on no fundamental news whatsoever, simply because larger players in the futures market are managing their positions in ways that have nothing to do with the underlying physical reality. And every single one of those moments, the sharp drops, the frustrating consolidations, the periods of silence while other assets are generating excitement, every one of them is a test. Not of the thesis, but of you, of your conviction, of your understanding, of your ability to separate short-term price noise from long-term fundamental signal. The investors who fail with silver almost never fail because the thesis was wrong. They fail because they bought with excitement and sold with anxiety. They bought when the story was compelling and the price was moving, and they sold when the price corrected and the silence became uncomfortable. They let the market's short-term behavior override their own long-term reasoning, and in doing so, they locked in losses on a position that, had they simply held it with discipline and understanding, would have ultimately vindicated their original thinking. I want to give you a practical framework for avoiding that failure. It has 3 components. The first is conviction built on understanding, not on price action, not on what other people are saying, not on the excitement of a moving market, but on a genuine, deep understanding of why the thesis is sound. The supply deficit is real. The ratio mispricing is documented. The industrial demand is structural. When you know why you own something at that level of depth, a price correction becomes information rather than panic. It either confirms your patience or gives you an opportunity to add at better prices. The second component is appropriate sizing. Silver should be a meaningful position in your portfolio, large enough to matter if the thesis plays out, but not so large that the volatility threatens your financial stability or your emotional equilibrium. An oversized position in a volatile asset turns every price move into a crisis. And crisis mode is not a mental state from which good financial decisions are made. The third component is a defined time horizon. Silver is not a trade. If you are approaching it the way the thesis demands, you are thinking in years, not months. Defining that time horizon explicitly, writing it down, reminding yourself of it when the price is doing something uncomfortable, is the practical anchor that keeps short-term emotion from overriding long-term reason. Gold investors who have held through multiple cycles know this framework intimately. Bitcoin investors who held through multiple severe corrections know it at an even more visceral level. The ones who built real wealth from those assets were not the most excited. They were the most prepared. Prepared not just with the right position, but with the right mindset to hold it through everything the market threw at them before the thesis fully materialized. That preparation is available to you right now, before the volatility tests you, before the correction shakes you, before the silence tempts you to question everything. Build the conviction, size the position wisely, and define your horizon clearly. Because the storm will come. And the only question is whether you will be standing on the other side of it. Silver to $1,728? Gold and Bitcoin investors watching. Part 5 of 5. The final warning and the decision that could define your financial decade. We have traveled through a lot of territory together in this video. We started with a number that most people would dismiss without examination. $1,728. We traced that number back to its mathematical and historical roots in the gold-to-silver ratio. We examined the physical supply reality that gives that number genuine, fundamental grounding. And we talked honestly about the psychological journey that stands between a sound thesis and the actual wealth that thesis can create for those who hold through it with discipline and understanding. Now I want to close this conversation with the weight it deserves. Because I think this moment, the specific convergence of factors present in the silver market right now, deserves to be taken seriously in a way that goes beyond charts and ratios and supply figures. I want to talk about what this moment means for you, for your financial future, and for the decisions you make in the days and weeks after this video ends. Let me start with something honest. The 1728 target may not happen in 1 year. It may not happen in 2. The timeline on a thesis like this is genuinely uncertain, and anyone who tells you otherwise is confusing confidence with precision. What I can tell you with far more certainty is the direction. And direction held with patience and discipline over a sufficient time horizon, is what creates wealth. Not perfect timing, not catching the exact bottom or the exact top, just being correctly positioned in the right direction for long enough. The direction for silver, given everything we have examined in this video, points toward significant repricing. The supply deficit is not resolving, it is deepening. The industrial demand is not slowing, it is accelerating. The monetary case, rooted in thousands of years of silver's role as a store of value, is becoming more relevant, not less, in a world of expanding debt and currency debasement. And the attention of two of the most sophisticated investor communities in the world, the gold community and the Bitcoin community, is converging on silver simultaneously for reasons that are independent of each other but point in the same direction. That convergence, that alignment of monetary history, physical scarcity, industrial necessity, and sophisticated investor attention is rare, genuinely rare. I have been studying financial markets long enough to recognize that these kinds of setups do not present themselves constantly. They build slowly, quietly, and then they resolve in ways that reward the patient and leave the reactive wondering what they missed. Now, I want to address something that I suspect some of you are feeling right now. A kind of tension between the intellectual case I have made and the practical reality of your financial life. You have bills. You have obligations. You have other investments that need attention. You have a relationship with risk that is specific to your situation and your temperament. And sitting here listening to a compelling argument about silver does not automatically translate into knowing what to do with that argument in the context of your real, specific, complicated financial life. I understand that tension, and I want to honor it rather than gloss over it with generic advice. So let me say this as clearly and as practically as I can. You do not need to make a dramatic move today. You do not need to restructure your entire portfolio or make a large single purchase driven by the urgency of what you have heard in this video. What you do need to do is take this information seriously enough to act on it thoughtfully, to do your own additional research, to look at your current portfolio and honestly assess how much of it is genuinely protected against the currency debasement and inflationary forces we have discussed. To consider whether a meaningful allocation to silver, built gradually and sized appropriately, belongs in the picture you are building for your financial future. The cost of doing that work is time and attention. The cost of not doing it, if the thesis plays out even partially over the next several years, is measured in something far more valuable: real purchasing power, real financial security, real options in your life that only exist when the wealth you have worked hard to build has been protected and grown in genuine terms rather than just nominal ones. I also want to say something about the broader context of what we have discussed today. Silver does not exist in isolation. It sits within a larger financial landscape that includes gold, Bitcoin, commodities, real estate, and the entire traditional financial system of stocks, bonds, and currencies. Understanding how silver fits within that landscape, how it complements other stores of value, how it diversifies genuine risk rather than just adding noise to a portfolio, that understanding is what separates a thoughtful allocation from a speculative bet. Gold provides monetary stability and centuries of institutional trust. Bitcoin provides mathematical scarcity and a new paradigm for digital value storage. Silver provides both a monetary history nearly as deep as gold and an industrial utility that neither gold nor Bitcoin can offer. Together, these three assets represent a comprehensive approach to protecting wealth against the specific risks that the current financial environment presents. Not individually as silver alone, or gold alone, or Bitcoin alone, but as complementary positions that address different dimensions of the same fundamental challenge: preserving real value in a world of expanding paper money. The investors who will look back on this period with satisfaction are not going to be the ones who made the boldest predictions or took the biggest risks. They are going to be the ones who understood what was happening, built positions that reflected that understanding, and had the patience and the discipline to hold through the noise until the fundamentals asserted themselves. That investor can be you. The understanding is available to you right now. The window, while still open, is not permanent. Here is my final warning, and I want you to hear it not as fear, but as responsibility. The financial system is in the middle of a transition, a slow, structural, multi-year transition away from the assumptions and arrangements that defined the post-war financial order. That transition will not announce itself with a single dramatic event. It will unfold through a series of escalating pressures, partial resolutions, and then larger breaks that force the market to reprice assets that have been mispriced for years. Silver is one of those mispriced assets. Perhaps the most dramatically mispriced hard asset available to ordinary investors today. And the window to accumulate it before the broader market reaches the same conclusion is a window that has a closing time. I do not know exactly when that closing time is. Nobody does. But the structural forces I have described in this video are not moving in a direction that suggests the window is widening. They are moving in a direction that suggests it is narrowing. Quietly, consistently, and with the kind of inevitability that only becomes obvious after the fact to those who are not paying attention. Pay attention now. While it still makes a difference, while the price still reflects the skepticism of the majority rather than the conviction of the informed, while you still have the opportunity to be on the right side of a repricing that, if the thesis plays out even partially, will be one of the most significant wealth transfers of this financial generation. That is the message of this video. That is what I want you to carry forward from this conversation. Not excitement, not urgency driven by fear, but clear, grounded, informed conviction that translates into deliberate, disciplined action. I am Kevin Price. And before you leave today, I want to ask you for something simple and genuine. If this video gave you real value, if it changed the way you think about silver, about gold, about Bitcoin, about the broader financial forces shaping your future, please take 1 second right now and hit that like button. It is the simplest signal you can send that this kind of serious, in-depth financial conversation deserves to reach more people. And it genuinely helps this channel continue doing exactly what we do here. If you are not yet subscribed, I want to invite you to join this community today. Every video on this channel is built on the same foundation. Honest, long-form, no-hype financial education for people who take their financial future seriously. No shortcuts, no empty promises, no excitement without substance. Just real thinking for real investors who want to understand what is actually happening in the world and what it means for their money. And please, drop your questions and your thoughts in the comments section below. Tell me what resonated with you. Tell me what you disagree with. Tell me what you want to go deeper on. I read every single comment. I respond as personally and as thoughtfully as I can. And the questions you ask in the comments are genuinely shaping the conversations we have in future videos. Your voice matters in this community, and I want to hear it.